Hi Arjun, thoughts on SMC and ICT. So what do you want to, are you like you were, what is the execution time frame? I would say start with 5 minutes and then you may shift to 1 minute. But if you have enough time to back test, then I would say back test the data of 1 minute also, because the best risk reward you will get is on 1 minute. If you have time to backtest, then I would say just backtest all the data. Start with 5 minutes. Okay. But if you have time, then uh, backtest 1 minute also, 2 minute. You were also doing SMC, I think, from the photon trading. No, how is your result? What is your thoughts on SMC?
This is primed in all retail traders by seeing the market begin to make lower highs and lower lows. The market appears to have an imaginary diagonal line it seems to propel price lower from. Retail traders will extend these imaginary lines into the future and attribute resistance theories to them. When price hits the extended imaginary diagonal line connecting lower highs, retail traders short at that moment. A trend line theory. Now, it's my perspective that there's no basis on trend line theory in the form of diagonal or diagonal resistance. And I believe it's just basically an opinion. There's no statistical edge that I've been able to build with use of diagonal support or resistance in the form of trend lines. Now, I've been doing this for 24 years coming up, and at the end of the month, we're actually producing this video, and I will have been a trader for 24 years. And in 24 years, I've done a lot of things in analysis. And I was indoctrinated with trend lines when I first started. And to me, it made perfect sense because I could see it in the past. And all the books give us perfect examples where it all works. But when we try to use the trend line idea, which lows do you draw connections to? Which highs do you draw connections to? And quickly, all of a sudden, then, like, oh, maybe this isn't as easy as I thought it was. But does price have an awareness of the point of trend line support? Or does price have an awareness of the point of trend line resistance? I'll submit to you that it does not. Price has no awareness of your trend line. Price doesn't respect what you have on your charts. Price only respects where the actual liquidity is in the marketplace. And because they can't see you because you're too small, the marketplace sees where the large pools of liquidity are. That means in buying interest and selling interest that's already in the marketplace in the form of protective sell stops, protective buy stops, or new buy stops for long entries, or new sell stops, selling entries. That's the only thing that makes price move. And it's going to be hinged and framed on context of who is in play right now, what smart money entity has the control of the marketplace at the moment. Is it going higher based on their book being bullish, or is it going lower based on their book being bearish? And that's what this mentorship teaches. It gives you those ideas to go into seeing where price is most likely going to go. And we don't subscribe down sloping trend lines or upsloping trend lines to formulate ideas in which we find support or resistance based on that idea. Do banks associate value or prognostication on the basis of trendline theory? I'll submit to you, no, they do not. Now, for some that are in the financial industry, maybe you're working at a bank, maybe you have used them in the past and you've had success. I'm telling you that banks don't have any association or prognostication placed on valuing a trend line level on a diagonal basis. And the reason why is because it's so subjective. You are associating future price movement to a level that hasn't been traded to yet. You're doing it on the basis of connecting two reference points in the past that don't have any bearing on what the future price is going to do. It has nothing. That high that you connected to a lower high, and you're looking for resistance or downtrending trend line resistance, that third time it supposedly comes up to that line, what makes you so confident that it's going to go down at that point? It's because you drew the line on your chart. So the banks don't care what you're scribbling all over your charts. They don't care about that. Not aware of it, okay? But what they are aware of is sentiment that shifts and builds around those levels because it's going to be many times being replicated on the fund level. Funds will get beat up. That's the basis of trading. Large traders are the prey. That's where the markets go. They go for their orders, not for our little orders, not for our little liquidity, okay? But because we learned to trade and herd like the fund traders, we are many times are casualties of that war between smart money and large funds. That's the business model. Large funds are cannibalized at reversals, but they're permitted to facilitate long-term trends when the markets are in that environment. But trend lines are not the key to it. Is the very nature of trend lines flawed at its core? I will submit to you that yes, it is. Because it gives too many dangling carrots in front of the trader's eyes, thinking that, okay, this is going to be an easy setup, so therefore let me go in here and sell at this resistance trend line, or let me buy at this diagonal support trend line. It's not that easy. Many times our charts will paint these beautifully disguised opportunities that are impossibility. Knowing this, how can market makers capitalize on this fallacy in price action? Retail bullish trendline support. In periods when price is making higher lows and higher highs, the use of trendline support will be adopted by retail traders. The influx of weak-handed or less informed money at an area or price level provides liquidity for the market maker. The chart may appear bullish, the underpinnings are in fact the opposite. The retail crowd will buy at a moment when price will be devoid of support. Price will collapse and leave the retail trader long with drawdown in the trade. When that third touch of that uptrend line is seen in price action, many times I get dialed in expecting the high that forms between the low at the second time it hits the trend line and the third time it hits the trend line that high in between, I aim in that high for a bearish order block, or I will be allowing price to just briefly poke its head above that high for a turtle soup, especially if the higher time frame charts that I use for my analysis indicate that we are not in a bullish environment, but the lower time frames will many times paint these beautifully illustrated uptrend diagonal support lines. So what I'm trying to do is I'm focusing in on when the market maker sets their traps for a sell scenario. Many times that high in between the low that forms at the second retouch of that trend line and the third touch of that trend line, the high in between, there is going to be a sell scenario that I'm aiming for in that. I'm looking for a bearish order block, or I'm looking for maybe sometimes on a lower time frame, I'm looking for a breaker, a bearish breaker, where the market has shown a willingness to rally up to take out a hold high that's on a lower time frame that may not be seen as clear with that high in between point number 2 and point number 3. All I'm looking for is a reason to be contrarian, because if the trend line looks so obvious, to me, I look at that as a trap. Retail bearish trendline resistance. In periods when price is making lower lows and lower highs, the use of trendline resistance will be adopted by retail traders. The influx of weak-handed or less informed money at an area or price level provides liquidity to the market maker. The chart may appear bearish, but the underpinnings are in fact the opposite. The retail crowd will sell at a moment when the price will be devoid of resistance. Price will rally and leave the retail trader short with drawdown in the trade. Between the high formed at point number 2 and point number 3, the low in between those 2 points, I'm going to be aiming for a reason to be a buyer now, because I will submit to you that if the higher time frames are indicating that higher prices most likely going to be in the near term, and we're trading at higher time frame support levels based on order blocks or institutional order flow, I'm looking for that low between high 2 and high 3. I'm looking for a bullish order block at that low in between the 2 points. And while price may drop down into that whole low just by a little bit, but not get down to that low altogether, I will be looking for a bullish order block to buy. Or I will accept a break just below that low for a turtle soup long entry, or basically a run on the sell stop. Many times the market will break through. Now, a point at which I want to draw attention to is the second point at which you have that trend line. In other words, the first high you see, and it comes down and makes a lower high at number 2, and it trades lower, and you think it's going back up to make a number 3 point high that's lower, or 3 times touching that downtrend. When the market rallies, I'm actually going to be looking for a move up into that second high, because that's where a lot of the buy stops are going to be residing. Same thing said, just an opposite when we're looking for that sell scenario in bullish trendline support. Retail is going to be looking for it to go higher. I'm looking for it to go down below point number 2. That's where everyone's stop loss is. Now, when you think about it like this, trend lines in the form of diagonal basis, support or resistance, really a toss-up. Do you have confidence that the trend line you're drawing is going to really provide support or resistance? Think about it. It's really associated closely to flipping a coin. Heads, you're going to be a buyer. And guess what? Tails, you'd be a seller. You're back to the same equation of chance. And we do not trade with the perspective of chance. When we trade, we look at the marketplace to provide clues in which the smart money is going to be utilizing the liquidity that's made available for willing or unwilling liquidity in the form of funds and uninformed money. You have to think like that liquidity provider. Prices delivered to engineer efficiency of smart money entities only. Okay, folks, let's take a look at examples here. I want to take a look at this high here. And price has a nice run away from that. You have a very nice
बिस्किट विस्किट नहीं है
high.
बिस्किट था तो
Price swing. And we have
तो बिस्कुट उसको ले आता है ना रस बच्चा कुछ भी
low of this candle, the high of this candle. There's only been down movement
छोड़िए अब
of
जाइए
this candle's body. I'm going to highlight this whole area in here. I'm going to reference the low of that candle. So we're going to watch price. That's if a reactionary level that we've been waiting for in the future. How we start the setup. Price starts to rally up. Trades right into that 52.34 level right there. That day it occurs December 11th, 2015. Over here on the right hand side, have the 15-minute time frame for December 11th, 2015. I'm going to delineate that same high. $52.34. You see price hitting it right here. Now I want you to look at how this low connected to this low here, projected out, eventually has another third time hitting it. Okay, so trend line followers that as a potential continuation will higher, finding some support here, 1, 2, 3, maybe a run up higher. Problem is we have a daily institutional reference point over here, and we're in that area over here. The whole shaded area, we've closed that in. So we would be looking for the next area of liquidity down here. So we can look at this range. And this down candle's high. This down candle's high. Up to this down candle's low. This candle's high and this candle's low. It's only been one pass on the upside. So we're going to be looking for price that will come back down into this candle's high in the form of 50, 60. Okay, so 150, 60. We know that there's a possibility to see price want to drop lower based on liquidity. We have trend lines here to be reasonable in terms of what retail will be drawing, expecting some bullish prices. I'll show you what it may look like. Okay, you have here, they're finding some support here, hold high back here. They could reasonably expect to see this to trade higher. Problem is the only thing it's done, move back up into the last up candle here, is a bearish order block there. So using the market efficiency paradigm, we don't see this as trend line support. We see this as a return up into the reason it gets short more. The market breaks lower. Market trades down into a low right here. We'll look at when we zoom out a couple minutes. A low here. We have another low here, projecting that low out in time. And you can see price coming down to that third time. Does it make a bullish scenario? No. It's going up to the last up candles, midway point, or mean threshold. Take a look at what that is. Okay. Right in here, equilibrium. Trading right there. Reference point. We're looking for price to come down and close in this void. This candle's low here, and this candle's high. When here has a liquidity void, we have sell stops below this low here. Again, focusing on the idea on the daily chart, the bank lid, looking for 150, 60 level. Up here, we're looking at this market move higher. Anything that we viewed as support diagonal basis on a trend line, we're going to look at that as suspect. And buyers are going to come in here in a big influx. We're going to have wonderful opportunities to be sellers today. Market trades up into equilibrium. One more time, pierces the high, turtle soup, falls off, and then trades rent one more time down into this level in here. Zoom out a little bit to a 30-minute chart. You can see that other trend line. So we have a low here. Then out in time, here's another low. Price comes down, hits it here. Is that a buy? No, it's only coming back up to this last up candle. Order block, sell here. Do not see this as a bullish scenario because of trend lines, as we're expecting this area here to promote selling. Okay, it's in an area in which we're going to be looking for sell-off. Price does in fact sell off. And you see the bearishness comes back above all the time. Turtle soup or bearish order block. Okay. As we're using a higher time frame setup here, stop would provide you an opportunity to put a stop above. Price accelerates, goes through what would be considered trendline support, and ultimately down into the 150.60 level. Let's take a look at some downtrending or bearish trend lines that are actually buy scenarios. First, we have this run up here. Down candles right to the upside. At 143.85, thereabouts. Open price on this. 143.85. A down candle, it's 43.85. I'm going to add 43.85 or lower time frame chart. 43.85. Price trading down to it here, hitting it one more time. High, lower high, third time price hits it here. You see this as a sell. No, we don't. You see it as a long here, or a return back to bullish order block. So it could be a buyer at 43.85 or 43.90 on limit, or if we get a fill at 43.80 or lower, be a buyer down here with the expectation that this is a false trend line, and we'll be looking for this high in here. One thing would be short. Have to buy something above this. Price rallies away, but real close to this high in here. Tracing it lower. Back down into last down candles here. That's a buying opportunity. And up here, where we'd be expecting to see buy stops tag. Yeah, buy stops right there. See that happening? Buy stops. Then you'd be permitted to see lower prices because seeing highs take buy stop read. Allow you to be testing. Here's another example. We have a nice down candle here, bullish validated, and the trades above down candle. Very next candle we trade up again, and the third candle it opens here and trades down into the body of the main threshold is approximately 144 figure, and the open comes in at 144. We have 46 pip range in here. The day on this candle is the 18th of May. See candle here, bullish, buy stops right there. See that happening? Buy stops hit. Then you'd be permitted to see lower prices because in high stick buy stop read allowed to be tested. Here's another example. We have a nice down candle here, bullish for block, validated, and trades above, down candle. Very next candle trade up. Third candle, it opens here and trades down into the body of the main threshold is approximately 144 figure, and the open comes. We have 46 pip range in here. The day on this candle is 18th May, 2006. See the 18th of May here, okay, and the high, lower high, can extend that out in time. This price sell off here a little bit, and then it comes up, pops through one more time. So traders that even see this as a downtrend that may have been broken, they may see this as a return back down into it to be a buyer. They're wrong there as well. Also, may see a classic chart pattern here. I haven't spoken about, but we're going to talk about it in this as well. Classic chart pattern, triangle, and false breakout here. They would have been wrong even trading with that. Holding up into one of the 146 big figure. Now, this one figure is the last up candle in the daily chart. It closed in all these down candles, so institutional flow. Let's see price come up and close all that in. So it's only been delivered downside, all down candles. Price has to be efficiently balanced by offering on buy side. Sold off and offered on the sell side. Price to be efficiently delivered has to be offered on rally back figure. That's why it quickly ran. But breaking this idea of supposed trend lines. See when the trades are seeing these retail fingerprints all over it, probabilities really shift in our favor when we're doing the opposite. So institutional reference point on daily chart. Hopefully you enjoyed this teaching. Go back through all your charts taking place. Go down to lower time frames and you actually see how these trend lines are really there. Phantoms. Retail chases them. If they see them, they're really not there. Ghost and that folks is the teaching number 8 of series of 8 for the month of November. We're talking about false tops and leads to head and shoulders. A head and shoulders pattern is typically seen with a price high, creates a small little retracement, then creates a higher high, then it retraces back lower, and then it creates another lower price peak. And then connecting those 3 successive peaks in price, we classically refer to that as the neckline. In classical support resistance ideas, where if that neckline is broken, many times you'll see it retrace, go back up to that neckline. In the form of selecting targets, you can measure the range from the neckline as peak, and subtract that range from the neckline once the breaks below it. That'll give you a reasonable objective. The problem with this pattern is because it's taught in all of our retail books and such. Every trader out there, when they first get into their charts, they're always looking for these types of patterns. But generally, price will form these genuinely at intermediate or long-term highs. And due to the low understanding of most retail traders, they tend to seek these classic topping patterns on lower time frames, and many times at a significant low in price, but they marry the pattern. The opposite is referred to as an inverted head and shoulders pattern, false bottom pattern. Teaching in here, we're not really teaching these classical patterns. They can be found on the internet. What I'm actually going to tell you is how you can capitalize on these patterns when they appear in charts and our higher time frame premise indicates the opposite direction. But an inverted head and shoulders pattern is typically seen with a short-term low that's met with a lower low, then it makes a higher short-term low, and you connect the highs that form around those three successive lower lows, and we refer to that as the neckline. Eventually, should price trade above that neckline, classically you would expect a pullback in price, retracing back down to the neckline, and then an advancement up to the target. And the range from the neckline down to the lowest low, those three lows, added to the neckline once the price breaks through it, that would give you a reasonable upside. Now again, much in the same way, generally price will form these genuinely at intermediate or lows. And again, much like we said with their classical pattern, due to the low understanding of most retail traders, they go into the lower time frames and they start looking for this classic bottom pattern on lower time frames. Many times at a significant high in price. But much like you probably done when you first started as a trader, you get these textbooks and you get these ideas and you go in, you force the understanding of what you learned out of the books into the charts. So therefore, you learned about head and shoulders patterns, therefore there must be a head and shoulders pattern right now. Let's go in there and trade it. And unfortunately, always equate to profitability. When I first started as a futures trader, this was one of the patterns that were really promoted hard because it's the idea that you want to catch a high and you want to catch a bottom. Picking tops and bottoms is one of the worst games to play, especially as a new trader, because number one, even seasoned pros don't do that, and we don't pick tops and bottoms. We can trade with rather impressive accuracy and catching significant intermediate term lows and short term lows and highs, but as it relates to long term tops and bottoms, try to avoid that, and I actually promote the idea of doing the same thing in your own trading. Try not to do that. But one of the coolest things I've learned by going through institutional order flow studies and watching how interbank pricing is delivered, it allows me to go in and actually see these patterns when they form in price charts. If I had a indication that the price is actually going to go higher and I see a head and shoulders pattern, which would be a false top, in my opinion, but in the charts, retail will see that as a top for me. Conversely, looking at an inverted head and shoulders, which would be classically viewed as a bullish pattern in price, if I see that happen when the market is bearish, I would be looking to go short. And where we see the neckline, let's go back to the standard head and shoulders pattern. When you look at the neckline, what I see there is an opportunity to be long once the neckline is broken on the downside, especially if we are in a institutionally framed bullish environment. That means if we're in a long-term or intermediate-term low and it forms a successive three peaks in price moving higher, which we lastly viewed as a head shoulders pattern, pure chartists would see that as a bearish indication, especially new traders or less informed traders. I like seeing when price does that because to me it's a retail trap, and market execs designing classical chart patterns in price where you can actually get tripped up thinking just because you saw the head shoulders formation and neckline's broken, when that neckline is broken, I don't see that pullback as a resuming lower or a new selling. I see that as a turtle soup long that took out two previous lows where the clean lows were there. I look at that as a buying opportunity. So I'll buy the sell stops below those equal lows or where the neckline is, and then I'll look for that head, the highest peak to be violated, and I'll try to pair up my long exits with the buy stops above the highest high in this pattern. And that would be my first objective. The inverted head and shoulders, I would do the opposite. If I'm looking for price action to be bearish, as a higher time frame would indicate, and I see a low with a lower low and a higher low, which would be deemed as a inverted head and shoulders, I don't see that as a bullish breakout above the neckline. I'm actually looking at that as a run on buy stops. And I'm going to look to go short there, not expect to see price go higher, but in fact, blow out those equal highs and then make a run for the sell stops below what we deemed as the head of this pattern, what would be the lowest low in the recent price action. You can actually take your first profit at shoulder in both these patterns, respectively. But let's take a look at a couple chart examples and see what this pattern looks like in price. Here, next, we're looking at a daily chart and we're showing this. So look at this down candle right before the up move. Valued for a while. Price came down and hit that same overblock right here. Closed in the fair value gap between the high and midway point of the candle. Look at this candle right next to it. Price came down, affected that range. In here, didn't go any further than that. And on this day here, it's August 10th. Traded through the down candle, making this a bullish order block. Given this candle's high with opening, sensitive, be a buyer. The high comes in at 155.46. But on this day here, get down into it on the 12th of August 2015. Get right down into the body of that down, which is now that's bullish on the deal. Let's take a look at a hourly chart. Meantime, August 12th. Here we have market making a high, higher high, and a lower high, and we have two equal lows in here. We have a head and shoulders pattern. Retail traders are going to see that as a selling scenario. So they're going to look for a break of this neckline and take their range from the high down to that neckline, track that, and that'll give them their objective. Okay, so we have that range here. Duplicate that, give ourselves downside objective for the retail mining route. The retail is going to think this breakdown here is going to lead them down to 155 or thereabouts. And here, retail is going to expect range expansion down to a low of 154.95. We do not expect that because in the daily chart, we're expecting the bullish order block to send higher. So while we see a regular head and shoulders pattern, which would be classical bearishness, part of price action, as it relates to institutional workflow, we're looking at the run below these lows in here as a sell stop. So we're looking at the market to go below here, pair up orders to go long. Those individuals who want to have a sell stop down here, already long, the trailing stop loss is going to be in form of a sell stop. Market move most recently has been higher. We see this move below these equal lows, opportunity to buy those sell stops. Those willing sell stops are flood the market when the market trades below here. So now we have a lot of liquidity. Remember that market efficiency paradigm. We see liquidity here going long. So we're looking for objective up here to take profits. So we could be a buyer at 155.50 and look for 56.20 above this high. 56.20. That's our objective, or 70 pips. Market runs 1, 2, 3, 4 more times below that low, gathering up the sell stops, and then expansion tears up the buy stop above 50, 20. And ultimately, you can see a nice little go back here. Okay, so that's an objective of using the head and shoulders pattern against what retail would expect, and using higher time frame workflow and daily chart, reading it as the banks would. Go back up to that daily chart and see what it did as a result. Not much of a move. That you don't need much of a move when you understand what you're looking for. Okay, I have another example here. This is the daily British County USDs. The down candle right before this big move up, highs in here, there would have been buy stops above these highs. This rally up takes out those buy stops. It comes all the way and closes in its range. All up here. So this liquidity board is closed in. Last up candle closes it in. More importantly, these stops were targeted with this down candle. That means that this down candle was a bullish order block, which is used to break buy stops that were in the marketplace here. So when price trades below it here, when price comes back up to it here, you're inside of a breaker. That's a bearish environment. 153.45 to 153.50. In that area, we're looking for a reason to expect some bearishness, but there's going to be a lower time frame. Retail will see patterns like this. We have a low, lower low, higher low, the inverted head and shoulders pattern. Draw your neckline on the chart. Okay, that's the high up here, and we're going to draw what will be considered the inverted head and shoulders neckline. Levels here. The difference would be low up to this neckline. Once we break above it, price trades above it here. Neckline is broken. Stops below here will be targeted. The selling up here, I'm going to break above the neckline. Not looking at that as bullishness in return for higher prices, but looking for it to sell off up there. So we would look for that run to sell into the buy stops of this high here and above this high. Wait for a run below these. It does give a lot more than that here, but nonetheless, it's not. 10, 20, 30, 40, 50, 60, 70, 80 pips or more running low. Go back up to the daily. Okay, we're going to look up at this high up here. Price trades up into it here. Low of the last up candle. And the body of the candle, you see the trades up into that as well. And we're going to look up at the 18th on October. Okay, so we have, here's the 15th, creating a head and shoulders inverted, so that would be viewed as bullishness. But if we get above that high, we can be a seller, because we would expect those buy stops to be viewed as breakout artists in inverted head and shoulders. We have that as bullish pattern. We're going to look at it as a bearish pattern. We're going to be the opposite of that. And you can do two things. You can use this here, or you can use the body of the candle like I teach. First volume is the highest body of the candle, so 5502 would be a sell. Be above it. Price trades to it here, so you can be a seller above 5502. 5502 is your area being bearish. Do not look at that as a breakout and a pullback to higher prices. Looking to see it sell off. Entry on buy stops at 5502. And the neckline, or the head down here, your objective would be to cover below that low right here. And there's no cover. ultimately runs one more time above that 52 level, the buy stops, and below it will be hit any opportunity and profits. So again, it's you look for the pattern, because retail will look for the pattern, but you're going to fade that pattern based on what you see on the higher time frames. We look for institutional order flow to justify this should be bearish. We look for a reason to be selling, not buying. And if we see inverted head and shoulders patterns on the lower time frames, retail's going to be all over that looking for bullish upside moves. And that's not what you see. So hopefully you found this one insightful as well. We're going to be attacking a lot of the retail-minded classical chart patterns throughout this ICT mentorship. So this is just the beginning of two that will fall victim to we're looking at the first of 8 teaching series for December 2016 of the ICT mentorship. We're going to be dealing specifically with the interest rate effects on currency trades. Okay, now in this module, we're going to talk about smart money accumulation and distribution, fundamentally speaking. And that comes by way of our understanding and hopefully your acceptance to the fact that interest rates are the single most influential driving force behind market. Understanding interest rate shifts and changes can assist you in selecting trades. Technical analysis in key interest rates can unlock professional money management movement. Technical analysis of key interest rates can unlock professional money movement. Interest rate triads provide a visual depiction of smart money accumulation and distribution. All right, so what are interest rate triads? Well, we have to start with a 30-year bond, which is the key long-term interest rate benchmark. The 10-year note, which is an intermediate term interest rate, and the 5-year note, which is a short-term interest rate. Now, these three interest rate markets are all futures markets. They're traded on the futures market exchanges, and by looking at price action, these three in relationship to one another, it will unlock a lot of the things that most of the time evade you when you're looking at price action type of setups. But overlaying or comparative analysis on these three interest rates unlocks price action. Failure swings at opportunistic times can validate institutional order flow. What do I mean by that? Well, in the very first teaching of this mentorship, the whole content delivery of September 2016, I gave you specific things to focus on. Those things that we talked about in September are going to be amplified and be able to highlight much more probable trade scenarios after going through this particular module. Okay, so what does smart money look like in price? And what's it look like? How do you know when smart money is moving in the marketplace? Well, first, let's take a look at what it looks like in bearish conditions. Obviously, there has to be some diametrically opposed view. And you have to start by looking at a base asset or benchmark. And in bearish conditions, that base asset or benchmark would be making higher highs. Now, the base asset or benchmark could be the Dow Jones Industrial if we're trading stocks. It could be the dollar index if we're trading currencies. It could be the CRB index if we're trading commodities. The smart money distribution can be seen by comparable assets that are closely correlated that are making lower highs. The reason why this is occurring is because the smart money is heavily distributing while the base asset or benchmark is moving higher. The public or less informed traders will be looking at the market making higher highs, for instance, on like the Dow Jones Industrial. They will attribute that as this is underlying strength, so therefore the market should keep going higher. But if the general market averages start making lower highs, it's actually indicating there's smart money distribution on the way. It's not new buying that's sending the price higher, but heavy distribution. In bullish conditions, the opposite is seen. You have to have obviously a base asset or benchmark to compare and assume that the base asset or benchmark is moving lower. It's going to be forming lower lows. Smart money accumulation will be seen with that condition being met with higher lows. Again, using the analogy that we just used a minute ago, assuming that the base asset or benchmark is the Dow Jones Industrial, it could be making lower lows, and by all standards, looking at it, the public or less informed traders would attribute that as underlying weakness, so therefore stocks should be continually going lower. But a closer look will see that some stocks are not making lower lows, and that is showing a graphic depiction or visual representation of smart money accumulation. Stocks were making higher lows. And the reason why this is occurring is because if they're heavily buying, price will not be permitted to go lower because that is the basis of supply and demand. If there's a high demand for something, it doesn't go on discount, it goes at a steady or higher price, and many times at a higher price. So to accumulate or buy more of that it will be pushed upon the buyer to pay a premium on it. They will not ever go to a discount. And the opposite is seen with the bearish conditions. When the underlying base asset or benchmark is moving higher, the reason why that heavy distribution is taking place is because they're selling it. They don't want to hold on to it. Their view, from smart money's perspective, is this recent rally higher on the base asset or benchmark, or in this case would be represented by an example like the Dow Jones. Because the Dow Jones is making higher highs doesn't mean always that's underlying strength. It could be just a heavy distribution cycle. And you'll see that with heavy numbers of stocks failing to make higher highs. Or the S&P 500 and the NASDAQ Composite Index failing to make a higher high. When that happens, that is a warning sign that you're probably in a distribution cycle. The interest rate triad. Again, we start with the 30-year Treasury bond market, 10-year note, and the 5-year note. And by overlaying these three markets, you'll be able to highlight when accumulation and distribution is in the interest rate market. And when this takes place, it represents smart money movement, or how you as a trader can view smart money in the form of seeing where accumulation and buying or distribution and selling is actually. The three interest rates should confirm higher high or lower low in the US dollar index at a significant price point. Failure swings highlight smart money participation in the markets, and trading opportunities are validated. For instance, let's look at the top. You see this graphic depiction. Now, this could be the 30-year treasury, it could be the 10-year, or it could be the 5-year. There's no demand on either one of these three being the failed lower low. Just need one to break that pattern of moving lower. When that happens, it invariably will show smart money participation in the marketplace. Because large volumes will be moving by way of their entries and exits, it causes that real supply and demand factor to take place in pricing. So therefore, the model will show underlying strength in one of the interest rates. In other words, they won't make a lower low. The one on the bottommost obviously makes a lower low, just like the one on the top graphically. But the one in the middle, which is highlighted in blue, that is representing a failure swing. So when that happens, what we're seeing is that there's an interest rate shift. So there's going to be a shift in the marketplace. And if this occurs at a moment when you're identifying a potential institutional order reference point or focal point in the US dollar index, that confirms that particular idea. For instance, if you're looking for a bullish order block on the dollar index, if you're looking for a buy at a bullish order block or supposed support to come into the marketplace of the dollar index, you would see a opposite of this indication here. You would see a higher high, probably on two of the interest rates, but a lower high on one of them. And what that would do is it would confirm bullish order block for the dollar. Okay, so when you're looking at the interest rate markets, now every chart I'm showing you here, you can get this at barchart.com. Free. Doesn't cost you any money to get that charting service from them. Now, looking at the chart like this, it's not easily ascertained what it is it's supposed to be telling you. And this is the reason why it evades majority. Simply because we can show a chart plotting open, high, low, and close on a specific interest rate doesn't always indicate understanding. And specifically, going through the 30-year, the 10-year, and the 5-year like we just did, having these on your charts, your analysis of the markets, if you break them down in the right manner, just simply having a chart doesn't do it. It's not found with your traditional analysis. You have to look at things on a comparative basis. Okay, so what I mean by that, let's take a closer look and we'll look at this move in the dollar index. We'll look at this reporting. See, the dollar index came down into that 99.50 level and had an aggressive rally. We talked about the dollar being bullish in this area, and the market moved higher all week as a response to that strong move off of 99.50 level. But if we go back and look at the interest rate market, and okay, this is the 30-year treasury bond market, that 90-minute chart looking at over about 15 to 18 days, and again, you can do all that on boardchart.com. The bond market between the 5th and the 8th and 7th, in other words, there was a failure swing that you can clearly see in the 30-year treasury bond market. In other words, we had a failed higher high. Now, when this takes place, by itself, it doesn't mean anything. But if you're looking for things to justify a long on the dollar, and you see a lower high on 30-year bond market, then we go to the lower time frame interest rate, and we're looking at another opportunity comparing the same highs. This one is relatively unchanged. We'll just say it's flat to neutral. So it didn't make a lower high in comparison, but it still didn't make a considerable higher high. And finally, for the 5-year, you can see that there was clearly a higher high formed on the 5-year interest rate or short term. On the short term curve, we made a higher run on the 5-year note, an unchanged high on the 10-year note, and a lower high on the 3rd-year. Now, by itself, that highlights there's a shift in the interest rate market. Now, what did we first start this module? That interest rates are the #1 leading driver for price action in the currency markets. There's nothing else that drives markets more wildly in currencies than the interest rates. That's what makes the whole world go round. So if we understand that we're seeing a divergence between the actual underlying 5-year, 10-year, and 30-year interest rate markets, you can see that shift is pronounced. You can clearly see it. You don't go into looking at the bond market just for these types of scenarios. You have to have a predetermined idea of what the market that you're about to trade should see in terms of bullishness or bearishness. That brings us back to the US dollar index. The same reference point in time between the 5th and the 8th or so, we saw that the dollar index went lower, made a lower low, and it traded down into a significant price level. Now, this is on a closing basis, and that's all you need. But the point is, we're seeing a significant divergence between the lower low dollar index and that of the 30-year Treasury bond, failing to make that higher high as it should have made comparably. When price moves into previous levels of institutional order flow, we as traders have to anticipate dynamic price movement. That looks like this. We talked about this week in live sessions. We had an old order block back in midpoint of November. It was the last down candle that had already been traded back down into it in November 15th. One more time, and it bounced away from that. But we traded all the way back down this week during the 8th of December just to get back to that 99.50 level, and it was strongly rejected. And the market rallied hard on the dollar index, which obviously would do what for foreign currencies? It would give us reason to trust shorter blocks, bearish turtle soups, or return back to fair value, closing in big ranges that dropped lower. Once those are closed in after a retracement higher, we look for a continuation and roll over the lower prices on foreign currencies. But this previous order block is what we would be looking for at that moment when price trades into that order block. You want to take a look at the interest rate markets to see if there's any clue that the smart money is working that level. So many people ask me, how do I validate what order block to trade off of? And I just told you with this teaching, if you can see the interest rate divergence or interest rate triad by looking at those 30, 10, and 5-year, if there's a divergence between the three and price is hitting a specific order block on the dollar index, that gives you the green light to go in refining the idea on that trade, because it's most likely a high probability. So if we saw a bullishness for the dollar index, then obviously we would be looking for bearish solutions for fiber. And the Euro USD, we had a level of buy stops indicated before the week started. And the market came all the way back up to an old reference point at 108.65, which is an old low if we go back farther on your chart homework. But if you take a look at what's happened here, the market rallied back above that 108.15, 108.20, clearing out the buy stops for all the 108.65, trading back to an old low. Not shown on this chart. Again, I'll leave that to you for your own homework. But the selling scenario was justified because we've seen the bullishness on the dollar, and that's the reason why we're expecting it to all through this. It kept doing, and as it related to the foreign currencies, it just kept driving them lower. And cable failed to make a higher high when euro dollar made a higher high and dollar made a lower low. So it's not always just simply looking for a divergence in one specific location or one asset. You have to blend a couple of things sometimes to get to understanding what the smart money is doing. You see that the market has a couple different opportunities to be short relative to the strong dollar, but what makes that strong dollar so significant is that it had a divergence in the interest rate triads. The 30-year, 10-year, 5-year had a failure swing at the moment that the dollar was trading down. Once you see that, it gets everything back in sync where the market's going to drive in one direction or another based on what direction the interest rates are going. So if the interest rate markets are dropping lower, that means interest rates are going to go higher, which means the interest rate's going to drive the dollar index higher. Dollar index is going to go higher. That's going to drive foreign currencies lower. And everything fits together like a cup. All the gears come together and they start turning. Everything makes sense, but it doesn't always work like that. Sometimes there's a shift that takes place on a longer term basis, and it may mess up on a short term time basis. You'll have to allow some of those things to come up in your trading and just trust the fact that over a long period of time, these scenarios will repeat themselves. When it does, it'll give you a plethora of trading opportunities. All right, so what do we do with this information? What can we do to build some kind of an action plan so we can use the information in a context where it helps us? Just talk about it now. Well, we have to use the points of focus taught in the first month of the mentorship. When price action trades to a